hours. Good morning, everyone. Sorry I'm a couple minutes late, but I got a flashlight in my pocket. That tells you how early in the morning I've had. So thank you for all joining us today. And I'd like to call the meeting of the Investment Advisory Committee meeting to order today. Welcome all of our IAC members and our staff and our guests who are on site and as well as calling in. I'd like for you to stand and join us for our Pledge of Allegiance and our salute to the North Carolina flag. Then I'll call on Ben to call the roll to determine a quorum. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the Old North State love, loyalty, and faith. Thank you very much. Ben, call the roll.
Good morning. This is Ben Garner, General Counsel for the Department of State Treasurer, calling the roll for Investment Advisory Committee. Mr. John Anarella.
Here.
Mr. Linz Brewer.
Good morning.
Good morning. Mr. Coakley. Here. Mr. Mevin. Here. Mr. Patterson.
Here.
And Treasurer Falwell. Here.
Thank you. Just to go over some housekeeping matters, if you have a cell phone, please mute your cell phone, and also be aware that in the spirit of transparency, this meeting is being recorded. And on top of that, any communication on a personal device that occurs during this meeting that has to do with this meeting can be subject to public records. Today's meeting agenda has been posted for public availability. If we happen to lose the electronic connection to the meeting, will be deemed in recess until we can put that on notice. So our first order of business is to ask for a motion to approve the previous meeting minutes.
So moved.
Second. Motion is second being made. Any further discussion? Hearing none, without objection, anybody who makes a motion a second will be deemed to be a yes vote. No further discussion. The clerk will call the roll.
Mr. Anarella.
Yes.
Mr. Brewer.
Yes.
Coakley.
Yes.
And Treasurer Falwell.
Yes. Next, we'll go into the performance update and present Christopher Morris, Chief Investment Officer, Chief Risk Operating Officer, with our co-CEO and Director of IG. Morning. Before you get started, I want to welcome. We have a lot of staff here today. Ted Brentz, Chief of Staff. Matt, thank you for running the ship today. Thank you.
We'll hop right in, kind of taking a look at the fourth quarter in contrast to the rough rest of the year, earlier in the year. We did see markets rebound some in the fourth quarter to wrap up the historically tough year. Inflation slowed some, coming off that 9% high to roughly 6.5% as we came near the end of the quarter. The Fed continued to aggressively fight inflation. On the equities front, S&P was up about 7.5% in the fourth quarter. We saw value continue to outperform growth. Strong quarter for non-U.S. stocks, particularly benefiting from the weaker dollar on the return side. On the fixed income front, more inversion of the yield curve thanks to an active Fed pushing short rates higher. During the two meetings that we had, FOMC meetings in the quarter, we saw the Fed fund rates go up a total of 125 basis points in those two meetings. Looking at the curve as a whole, the front end was up sharply with those Fed moves. Intermediate rates held fairly steady, and long rates were up slightly, 17, 18 basis points this morning there. Good quarter for credit, with spreads tightening in investment grade as well as high yield markets. And then kind of taking a peek into 2023 with the Fed, the futures right now are showing a total of another 75 basis points across the next 4 meetings that are scheduled. And then the futures are showing a rate cut actually by the calendar year end. So A lot of uncertainty past those or at least the next couple of meetings probably, but that's what the current look is in the futures market right now. That'll turn over to Chris.
Good morning, everyone. Turn to slide 7 on the deck. Before we get into the portfolio itself, we put this slide in here to kind of refresh kind of the capital market expectations and where we currently are. As you guys all know, we completed our asset liability study just about a year ago, where we had our separate capital market assumptions and set our asset allocation based off of those. Well, since there's been a pretty significant shift in market dynamics last year, specifically with the large increase in rates, we thought it was a good idea to refresh those compared to what we used in the study last year. So that's what you see here. So this chart shows the expected returns for each one of our asset classes and the total pension plan. The blue bar is the capital market assumptions that we used last year in the study. The orange bar is the refreshed expectations based on kind of where we currently are with the markets. And then the gray bar there is the difference between the two. So you'll see the largest change in the assumptions kind of in the middle of the chart here with IG fixed income and with cash. And that was essentially due to obviously the large increase in rates over the year that we saw. The assumption that we used in the study projected rates increasing over time. They would normalize over 5+ years, which led to our sub 2% fixed income expectation at 1.85%. You can see there. Well, we didn't get that slow normalization of rates. It all happened in 1 year with Fed funds rate increasing over 4% in 2022 alone.
So great yield reset of 22.
Yeah, exactly. So something we projected over time would happen, basically happened in 1 year, which led to those significant negative bond returns that we saw last year. But I guess the good part of that, it resets kind of future expectations. So you can see kind of what our expectations are going forward. IG fixed income goes from a sub 2% expectation to north of 4% expectation for the next 10 years. And then obviously cash return is higher as well. And, that trickles into a lot of the other asset classes as well, the way that it's modeled. So bottom line there is on the total plan, you can see that the right bars there, our 10-year expected return went from about 5.6%, which is what we showed in our study last year, to 6.7% now. So 1.1% change. Of course, that 1.1% we're going to need over the next 10 years to essentially make up for the negative 10% return that we got last year. So, it doesn't change kind of our expectations. It doesn't change really what we think we need to be invested in. It just kind of shows how one pretty significant year, especially with what we saw with bonds last year, it changes just the go forward expectations, right? Overall, we would expect the 10-year return to be roughly the same if you went back a year, if that makes sense. So anyways, we just thought that would be a good idea to refresh that, given what happened last year, given obviously the negative return environment that we had overall. But it does lead to higher expectations for the next 10 years.
And Chris, because this chart looks so much like another chart we're going to see in a few moments, this is about return expectations.
Yes, so it's the 10-year.
Not our returns.
Correct, yes, the 10-year expected returns.
Right.
Forward looking. Yes, forward looking.
Thank you.
And again, we obviously built in as volatility around that as well. You're obviously not going to get that every
It is nice to see it at above 6.
Yeah.
It really is, because if you go
Yeah,
back
I mean, that
what, 5, 7 years ago, we were talking about, hopefully maybe one day again, we'll average 6%.
right. Yeah, exactly. And a lot of that is the fixed income environment, right? When we had 0% rates or close to 0% rates, that's the starting point for that fixed income return, right? Which is why we had kind of that sub 2% expectation. Now that's much higher. It was very painful getting there, but now where we're at, it certainly helps out with the expected returns going forward.
As long as it doesn't.
What's that?
As long as it doesn't.
Right, exactly. Yeah, obviously no guarantee in any of this. All right, so now we'll turn to the portfolio. Slide 8 shows our current assets under management, just south of 165 billion at the end of December, which was up about 3.3 billion for the quarter after a strong Q4, but down over 11 billion for the calendar year. For the year, NCRS, the pension plan was down over 14 billion in straight market value. The majority of that was due to obviously the decrease in the markets. Did see a strong amount of inflows into our cash management program. That was up about 6 billion for the year. And then the other two pieces were down as well due to kind of the market decrease.
And it looks like your pension cash in the pension fund seems to be growing but very slowly.
The cash within the fund?
Yeah, which is the if we go back to June 2018.
Yes.
You're right at 100 million.
Oh, the overall, yeah.
Yeah, and today it's at 100, maybe 105 million, something like that.
Not pension cash.
Not cash. You mean the pension plan itself? So the blue bar
Yeah,
there is,
the NCRS.
yeah, CRS, that's the entire portfolio, right? So yeah, that's the entire pension plan. So yeah, that is at, well, just under 110 billion at the end of the year. A little bit higher than that now with the rally this year. But yeah, so I mean, it peaked at over about 133 billion at the end of 2021. So it's certainly down significantly since then, but overall, grows over time.
And Chris, the cash, is that ARPA funding? That all these.
The increase in cash, I mean, we don't have a lot of clarity into what goes into that because that's outside of the pension. A lot of general fund money, highway trust fund money, other governmental
Other participants.
within our STIF program. We don't have a lot of clarity into what drives a lot of those cash flows, but we definitely saw a large increase. Really, in the first half of last year is where we saw all of that. But that portfolio continues to grow as well. I think we talked about that at the last meeting, but I think that's still at all-time highs.
Yeah, 51. January.
Moving on to slide 9. So this shows our asset allocation at the end of the year. Portfolio ended the quarter, as I said, at about 109.3 billion, which was up from 105.7 billion at the end of September. So obviously a good quarter. Markets rallied in Q4 after a really tough first 3 quarters. In terms of portfolio positioning, no major changes in Q4, slightly less underweight equities with the rally that we saw. The growth underweight was at 7.1%, majority of that coming from public equity. We continue to be overweight rates and liquidity at 6.3%, with the cash portfolio comprising all of that overweight. Inflation sensitive and diversifier portfolio is just under the target at the end of the year, but this allocation has grown throughout last year as this part of the portfolio performed quite well, specifically compared to the other pieces of the portfolio, right? So we did see the inflation sensitive allocation do well, which Ron will talk about in a little bit. Core real estate did well as well, and we saw some good diversification from that part of the portfolio, which was nice, as obviously equities and bonds was the place to be. And in multi-strategy, we continue to be quite a long weight at 1%. Moving to the next slide, just the more recent snapshot. So this is as of a little over a week ago. Portfolio was up pretty significantly in January as the markets rallied. We were right around 113 billion as of February 13th. It's come back a little bit since then, but it's still around 113 billion. Again, no major changes in portfolio positioning. The underweight equities continues to decrease as markets rally. So we were only underweight equities about 2.7% as of this date. Moving on to slide 11, which is the portfolio returns versus our benchmarks. So this will show how the portfolio performed over these various time periods. Portfolio was up about 3.9% for the quarter. Again, good quarter for both equity markets and bond markets. Our equity portfolio was up more than 10% for the quarter, so that was nice to see. Again, after a tough first 3 quarters. But the calendar year plan was down 10.4%. Has negative returns in both kind of equity and bond markets, drove down the returns of total plan. That 10.4% return was the worst 1-year return that we've had since the great financial crisis, since 2008. So with the challenging return environment last year, you can see that the portfolio has only exceeded the actuarial rate of return of 6.5% for the 20-year time period. On a positive note, relative performance continues to be very strong. We significantly outperform both the implementation benchmark and our long-term policy benchmark for the 1-year time period. The outperformance was driven mainly by the positioning of the portfolio, which you'll see in kind of the attribution charts in a minute. Being underweight equities, overweight cash, really drove a big part of the outperformance, as well as strong relative performance from some of the asset classes, specifically IG fixed income had a very strong relative return last year. For the longer time period, still showing strong relative returns against both these benchmarks as well. So that's what we like to see. Looking at Q1, quarter to date, both equity and bond markets rallied pretty significantly in January. Like I said, they've come back a bit in February, but still pretty significant increases since the end of the calendar year. Portfolio itself is up roughly 3% for year to date. So good start to the year. Kind of expect more volatility going forward, but hopefully we can continue that strong start and have a much better 2023.
There's something that 1 year is pretty remarkable, that asset allocation in this cash that essentially protected $6 billion. That would have had losses if we might have matched the benchmark. It takes a long time to make up $6 billion.
It does, yeah. I mean, there's no doubt that with the cash had pretty significant benefits, and the underweight equities for last year. Equities were down more than 20%. We were underweight IG fixed as well for most of the year, so that helped as well, given that the bond markets were down pretty significantly as well. So you'll see in the attribution piece later kind of exactly what drove that, but yeah, certainly was accretive, no question. Moving on to slide 12, kind of the growth of the dollar chart shows the growth of the portfolio since really the inception of our total return that we have in 1997. Really what we're looking for here is, over time that the total pension return and the total pension plan outpaces both of our benchmarks. And you can see the orange line here is the pension plan, the blue is the implementation benchmark, and the yellow is the long-term policy benchmark. And you can see that the pension plan return is above both those others. So that's what we want to see over the long term. Slide 13, same chart over different time periods. And then we also added in kind of our total alternatives allocation to see kind of how that's adding value over time. And again, you can see the 5 and 10 year time period, the total pension plan has exceeded the long-term policy benchmark, which is good. You can see the green line there, the alternatives allocation is above both those lines. So you can see that the alternatives allocation is adding value over both these time periods. Moving on to slide 14. So this is the contribution to the total plan return for the 1 year. This shows really how each asset class has contributed to the 1 year return, both in terms of earnings or dollars as well as percentage. So you can see the total pension return of negative 10.4%. You can see on the top right there, that equates to a loss essentially in earnings of about 12.1 billion. I mentioned earlier that the pension plan went down over 14 billion last year. The difference there is that between the earnings and the amount of money that we pay out in benefits. So there's kind of a dislocation there. We also pay out, roughly 2 billion a year in benefits. So the market value went down a little more than 14 billion, but the earnings lost, I guess, as a result of this negative 10% return was about 12 billion. So yeah, as you'd expect, you can see that the drivers of that loss and of that negative return was public equity and fixed income. You can see both here that, public equity led to about 7.4% of that 10.4% return. Now, that's not saying that that's what public equity returned. That's the contribution to the total. Public equity was down more than 20% last year. And then you can see fixed income as well was a big driver of the negative returns. On a positive note, you can see kind of the diversification parts of the portfolio. Cash was additive, as well as alternatives as a whole, right? You can see the alternatives piece added kind of 0.37% to the total plan. So the diversification really helped a lot. If we had a lot more in IG fixed income and public equity, the return certainly would have been a lot lower. So moving to slide 15. So the attribution. So you can see here, as I was mentioning earlier, the plan outperformed the benchmark by about 1.5% for the 1 year, which is on its face good. Obviously, still down over 10% for the year. The majority of that value add was driven by the allocation effect, as you can see in the top right there. And that is how we are positioned versus our policy targets. So as I was saying, the underweight to equities, the overweight to cash, that was benefited the portfolio by about 1.47% last year. And you can see kind of where that's driven in the bottom charts there. You can see the overweight to cash, the underweight to public equity, that drove the vast majority of that allocation effect. On a selection effect basis, pretty flat for the year. Equities struggled on a relative basis for last year. Longer term performance still looks good there. But you can see on the bottom right here, kind of the additive piece of IG fixed income was pretty substantial as well. So I think we had our best 1 year relative return in history for the core fixed income book last year. So,
They've taken a lot of hits for your decisions too. It looks great now looking behind it, but I'm sure it was hard maintaining your allocations over the last 14, 18 months. Sure. So great job standing in the fire.
Thank you. Yeah. So that's the 1 year. Looking at kind of the 3 and 5 year on the next two slides. The 3 year portfolio was slightly underperformed on the 3 year by about 10 basis points. Again, most of the selection effect was positive for the 3 year. The allocation effect was slightly negative. Those kind of offset each other. So it's pretty close to the benchmark. But the positive nature of that was driven by selection effect over the 3 year time period. And then on the 5 year time period, you can see similar story. We did outperform the benchmark by about 20 basis points over the 5 year, and that was mainly driven by the selection effect and the outperformance of each underlying asset class. So I'd like to point out, that's really what we love to see it in terms of the bottom right chart there. Every one of those asset classes is to the right of zero, which means all of those asset classes outperformed versus their individual benchmark for that 5 year time period.
Paid out.
So yes, I mean that's obviously what we love to see over longer time periods. We know there's going to be time periods where portfolios underperform, but over the long term, if we're seeing that, then we're pretty happy with that result.
And you're hitting your 20-year numbers too. So
yeah, it certainly helps. Yeah, I mean if we're adding alpha on that part of it, it certainly is accretive to the total plan pretty significantly. Moving on to slide 18. So these are the risk metrics that we show every time. And I just want to kind of focus in on the top left, the rolling volatility chart. You can see, it's been extremely volatile. If you look at the blue line, up and down since really 2020 time period, where we've had pretty significant shifts in volatility. But if you look at the longer time periods, the gray line and the orange line, which is the 3 year moving average and the 5 year moving average, you can see that exiting kind of the 2012 time period, both of those metrics decreased significantly, and we got to a total plan volatility of less than 5% for a number of years, which is really, really low. So we had this long period of really low volatility, and we talked about it back then about how it's extremely unusual. Well, I mean, that changed quite quickly, obviously in 2020, and we've continued to see that throughout the last really 3 years. So you can see that, the gray line and the orange line there have jumped significantly in the last few years, and you can see that they continue to trend up as well. So just kind of the regime of low volatility that we had for a number of years, that certainly has shifted, and we're no longer in that kind of market environment. I wouldn't expect us to really go back to that low volatility anytime soon. So it's just interesting because, we talked about for a long time how low the volatility was in the portfolio and in the markets itself. And that certainly has changed. And we're obviously seeing that play out in a lot of these metrics here. Slide 19. So this is kind of the downside chart that measures kind of our how well we do during drawdown periods, which is a good chart to show for last year. So you can see the bottom chart there shows how the pension plan does versus different metrics, different benchmarks in drawdown scenarios. So you can see, the orange line there is the pension plan, how much that lost, and versus the blue, which is our implementation benchmark, the yellow, which is our long-term policy benchmark, and then the green, which is just S&P 500, so the equity markets. And you can see that, the orange is much higher than all of those benchmarks, which is kind of what we want to see is that, during drawdown events, we want to have good downside protection and be able to protect that versus these other benchmarks that we are measured against. So, certainly wasn't a good year on an absolute basis, but I think when you look at some of these underlying metrics, we've certainly done pretty well, versus our benchmarks and versus kind of some of the other metrics that we measure. So moving on to slide 20, which is the universe comparison. So again, this measures us versus the U.S. public fund greater than $20 billion universe that BNY Mellon, our custodian, has. So it's not every public pension plan. We don't really have transparency on saying exactly who it is, but there's, I think, around 13 or 14 that we're compared against that BNY Mellon has the data for. So, for the 1 year, we were in above median and at the 44th percentile. So, given our large allocation to IG fixed income and longer duration IG fixed income than some of our peers, we were lagging quite a bit the first half of the year on a lot of these metrics. But for the full year, we were above median, so that was good to see. Over the longer time periods, we've struggled a bit versus our peers on returns, but on the bottom half of this chart, you can see the risk piece of that, and we've always been one of the lowest risk plans of any of our peers. So, we kind of take that in stride where we're one of the lowest risk. We wouldn't expect to have as high returns over the long term, right? But there's a reason we've chosen an asset allocation like that. We want to be more conservative given our well-funded nature, where our peers don't necessarily have that luxury and they have to really ramp up the risk to try to earn a much higher return, right? The next chart, universe comparison. Again, this is just Sharpe ratio, which kind of compares. So it's a measure of risk-adjusted return, so it kind of combines risk and return. These ones are a little bit tougher to measure in shorter time periods, given sort of market dynamics. But what we like to see over the long term is that we were typically very strong in terms of our percentile ranking versus our peers on this metric as well. And you can see the 10 to 20 years we typically rank pretty strong.
Can we go back to the previous chart?
Yeah.
So for 3 and 5 years, we've been in the 94th percentile on risk.
Yes.
But for the 1 year, we're 63. So tell me what did that?
I would assume that was mainly due to the fixed income market and the fact that the volatility in the bond market was so high compared to what we've ever seen. And we do have a larger allocation to fixed income than a lot of our peers. So I would imagine that's what drove it. Well, so the 63rd means we're riskier, right? We want to be as low as possible from a risk percentile, right? So the 94th percentile means we are the lowest risk, right? 63rd percentile is we're still lower risk than most of the peers, right? We're below median,
right?
But we're not the lowest. And a lot of our peers have a lot more alternative allocations, and we know the timing delays on that.
Right.
We know kind of the smoothing aspects of that valuation sometimes. So from a risk, which is measured by really just it's a standard deviation of return, so it's just the volatility of the portfolio, right? If you have more public markets, typically fixed income's has very low volatility, right? But not last year.
Or it all sets.
Exactly. Or yeah, it's very well correlated with, or correlated, but lower correlation with equities. That didn't really happen last year, right? Equities were volatile, bonds were volatile. So that's what I would assume that's what's driving that, right? We don't have the underlying data of the other peers.
Okay.
To do a real good comparison there, but I mean, I would assume that that's the case.
Yeah, absolutely. Usually that anchor's holding us to the bottom, blowing all over the place last year because of what happened in the fixed income marketplace.
Thank you. Sorry.
Moving on to slide 22, so liquidity profile. Not much changes here from quarter to quarter. We kind of show our liquidity allocation in terms of dollars and in terms of percentages on the left and then on the right. And, you know, we try to have what we call level one liquidity. We try to have at least 70% of the portfolio level one liquidity, which is essentially public market liquidity. We'd be able to exit it quickly if we needed to. And right now, the portfolio is at about 74% in terms of level one. So still extremely liquid, something we obviously monitor on a regular basis, but that doesn't change dramatically from quarter to quarter. Moving on to the next slide. So this is the net benefits by calendar year. You can see that paid out just about $2 billion in net benefits last year. You know, it's been decreasing slightly over the last few years in terms of the net benefits, but as we talked about before, we would expect that not to continue and that we would be on the hook for more and more as time goes on. But we also measure it versus the total allocation to the plan, and that's kind of that orange line versus that dotted line. You know, we never really want to see it go above that dotted line very much. That means we're paying more than 3% out of the plan per year, which becomes more, if you get way above that, it's going to become increasingly difficult to, you know, fund these benefit payments and have a normal kind of asset allocation in terms of how we want to manage the plan. So it's good to see that that orange line has been decreasing over time as well. And that's, you know, that's less than 2% of the plan right now, which is good.
I continue to be shocked that these bars are going down.
Yeah.
Given the fact that people are retiring earlier and living longer. It's always been a mystery to me.
Yeah, it is. And we've looked at that in the past. And yeah, I mean, it has to do with the funding policy of the plan and that it's been really, really well funded. It's being really, really well funded kind of on the front end. And we looked at the longer term and that trend is not going to continue. So, you know, we kind of get it on an operational basis when they need the money. They come to us every month and say, we need this much money for teasers. We need this much money for local government. So we kind of see it more on an operational cash flow perspective, but you know, longer term liabilities are going up just for the reasons you said. So that it's not going to last. I don't know how long it's going to last. Again, it's great for us as we keep more money in the plan, right? We can earn more money on it. So I mean, to the extent that that continues, that's a great thing, but it won't continue.
Right. Okay, remind me you said that here.
Yeah. So slide 24 gives us a snapshot of our liquidity profile for our alternative portfolios. This just shows kind of how much cash is flowing to and from kind of all these underlying alternative portfolios. And, you know, we've been in a cash flow positive environment for a number of years now, and we continue to see that. Even with the volatility last year, we saw a substantial amount of realization with asset classes. You know, I think Ron will talk about, you know, some of the flows we've seen in the inflation portfolio, given that portfolio did well as well. And for the 1 year time period, we had, you know, a net cash flow across this entire book of about $2.5 billion. So we continue to see cash flows coming from these funds, which is obviously accretive to the total plan. And the last slide I'll hit is just the valuation lag profile. So we talk about how part of the portfolio is valued not daily, but more on a lag basis, so monthly or quarterly. So, you know, mainly the closed-end kind of private equity type structures. We receive the valuations on a quarterly basis, usually 45 to 60 days after quarter end. So you can see here that the percentage of the portfolio that is valued daily is at about 74% right now. And then about 18% or so is valued on a quarterly 1 quarter lag basis. So, that leads to obviously some of the smoothing in total plan returns. And, again, when we're comparing ourselves to our peers, it's something we have to take into consideration because a lot of our peers do have more of those type of structures. So their valuations are being lagged, as are ours for, 18% of the portfolio. But if they have 30 to 40% of the portfolio in those type of structures, it makes it more difficult to compare apples to apples in terms of return. So it's just something else you got to keep in mind when you're looking at really comparison of peers. Because asset allocation plays a big part of that, whereas we have 80+% of the portfolio that gets valued at least monthly on a real-time basis. Right? So with that, I'll pass it back to
Chris, I have a question.
Yeah.
And I know I've asked this question a few times over the years, but at some point in the fourth quarter, we were at the end of the quarter, we were at our minimum for public equity. So I assume at some point in the quarter, we're below our minimum. What is the process when something like that happens when we go
below the ranges? Yeah, I mean, it's more of an analysis and a conversation with the treasurer in terms of where we are and whether we think we need to do something immediate or I guess wait it out depending on what the market environment is. But yeah, so that means, I think we did breach that at some point in Q3. But we're well within our ranges now, given markets have come back.
But we didn't, that was all market appreciation. There was no sense of, hey.
The majority of that was, we put more, we did reallocate some funds, I remember when, into our new internal allocation. 500, it's 500 total.
800.
That portfolio now is 500 in it. We did that over time last year. And then we have been putting some more funds from cash into public REITs as well. We have been allocating that over kind of dollar cost averaging into some of those. So, we are doing some shifts, but nothing, I guess, major in terms of complete overhaul of kind of where we are from an asset allocation perspective.
And we leaned into the bond market in the fourth quarter.
Yes.
New investments and longer durations and bonds at 6% in some instances.
Yeah, so I'll touch on that real quick if you want. So
Yeah, well, let's see if John.
Oh, no, I mean, we preach to our constituents, dollar cost average, that's the long term. So we're below our minimum. We should be assessing what we're doing.
I'll touch real quick on what the treasurer was talking about. So, and we mentioned it a little bit of it last meeting on some things that we were going to do differently inside of our IG fixed income. So number one, we started to try and work on pushing the duration back towards in our core portfolio towards neutral. But the thing that was really different for us is we talked about doing some short investment grade fixed income as really a substitute for our cash allocation, that 10% of our core that we've been had in stiff. And that really was because of where rates were and where the opportunities were in real short credit, IG credit specifically. So we did get a little over $1 billion put to work in the fourth quarter on that in new money, targeting north of 5% yields on those, which looked a lot more attractive than what we were getting in our short term at the time. And then a combination of new securities and as well things that we would normally roll in our core fixed income book out to keep our duration. We went through and the team looked at all the credit side of things, and we took some of those securities and instead of selling them, moved them into that book. So right now we've got roughly $1.8 billion in that short investment grade fixed income book, which is about 6% of our core fixed income allocation. Look at that as tactical. As an example, if I was working out, I remember looking at the numbers in January, and I think our stiff return was like 20 basis points for the month, and that was over 1%. So it was 5x what we would have gotten in the other. So probably don't intend to do a whole lot more than we have in there, but feel good about what we have in there. And it's all basically 1 to 3 year investment grade high quality bonds that just look real attractive historically on the yields, higher than you're going to get buying it a little farther on the curves.
4 to 6% range.
Yeah, well, really almost always been north of 5 at purchase. Now we've seen some of those spreads come in a little bit, but when everything went on the books, maybe a couple of exceptions, everything was north of 5%. So some pushing closer to 6 early on too. So excited about what we're able to do there and take advantage of it. And we'll kind of the plan is to let those bonds kind of just mature on out and we see our stiff rate and everything kind of continue to increase. We kind of go back to normal mode here at some point.
We talked about that and I directed them to do that, but even as little as that sounds in the overall scheme of the bond market, they had trouble finding things that met their criteria. So we put as much as to work as we could.
Yeah, I mean, credit to Brett and Brad on the desk there. He had to work pretty hard to get that $1 billion in the ground in roughly a couple month time frame. So great job by the team on that. So taking a look at slide 26, asset class net of fees performance on the 1-year number, talked about all the challenges in the market. On the positive side of things, really positive returns, non-core real estate up over 6.5%, inflation sensitive up over 9%, and our core real estate over 5.5%. So those are kind of our strong performers for the year. And then obviously challenging in the public equity. We talked about the challenges in fixed income, stress down as well. I think one takeaway here, and I mentioned this before, is the age-old question you have is on doing private markets is you're taking less liquidity, little higher implementation costs of doing publics. Does it pay off in the long term? And the easy look at there is look at private and public equity and over the long term. That answer is a clear yes for us on that being a good decision point for the plan as a whole. We look at those relative returns to public markets.
Of course, your investment grade fixed income, you beat the benchmark about 3%.
It was a pretty, as I touched on last time, that was by far our best relative returns. And that really was what we had talked about all leading up to that. The combination of good credit decisions. It was a combination of certainly driven by short duration that we talked about. So, while it was a bad, ugly year for fixed income, I really felt like we did as well as we possibly could have in that environment and protecting 3% on that big of a part of the portfolio. So.
Yeah, we saw an attribution earlier. I mean, that right there added 90 basis points of value to the total plan, right? So that's pretty significant in terms of really savings, right?
Are you investing anywhere in longer duration treasuries or?
We are now. As part of pushing that duration out, we've moved a fair amount here in the last 6 weeks, and we'll continue to not necessarily looking to go overweight long duration relative to our benchmark.
But the 7 to 10 year.
We've pushed out. We bought some longer paper too, because we had been so short on that.
Right, but it was a bad play a year ago.
Yeah. With this yield reset now, we feel certainly a lot better putting that money to work. At these rates and kind of getting more neutral. It's not that I think a reflection of that return expectations as a long-term holder are much higher than they were a year ago.
20s? Are you buying 20s?
We bought across the curve. We bought 10s, 20s, 30s. Because we had a lot of stuff that had rolled well inside of 5 years intentionally. And now we've said, okay, let's go ahead and put some of this money, back out in the market. So I think in total, the last program we did was, off the top of my head, it's close to 300, 350 million. Yeah, our last wave. But I think in total, we've moved well over $1 billion out the curve some, and we'll continue to do so. We're still short duration, but we're going to continue to narrow that gap.
And to be fair, the 12% drawdown on the 30 billion of IG fixed, since we're not forced to sell anything, when we hold that to maturity, all that will come back.
Right. And it will mature at par.
There's something that's really wrong with the U.S. government on the treasuries yet. So we feel.
Is that the only caveat?
We feel
All the things you could have said, you couldn't say that.
we feel good about a lot better about fixed income going forward, certainly than we did a year ago. You'd heard us talking about being really bearish, and now we feel a lot better about things.
You want to Oh, you're gonna talk about inflation.
Yeah, I'll touch on here, yeah. So the next chart on 27, the data is kind of the same since the 1-year number and the calendar year number obviously sync up at year end. The top right, the inflation sensitive up top. I think seeing that number up top there at over 9% in what was certainly our high inflation environment, I guess just tells us that it's fulfilling the role of the portfolio. So, and then the plan allocation number. So great to see that doing what it's supposed to do in that environment. So
Yeah, no, I would think, again, we put this in place over 10 years ago now, this inflation sensitive, and we had such low inflation for so long. Never really proved it out that it actually did what it was expected to do. But then you can see even in the last 2 years, right, it had almost a 12% return in 21 and then a 9.4% return in 22 as inflation's high. So did what we expected it to do and was certainly a very good diversifier for the plan in such a bad year for equities and bonds.
When inflation
Ron
jumps-
begged to get on the agenda this week. We'll talk more about that, but and obviously at the bottom, you see the challenges in the public markets we talked about in IG fixed and public equities. Moving on to slide 28, our new incremental and unfunded commitments. On the left here, we have anything new. We only have 2 new things on there since our last meeting, $200 million in non-core real estate and a $300 million commitment in opportunistic fixed income that were done since the last meeting. On the right are unfunded commitments. You can see at the bottom the total of 6.9 billion there. It's pretty much, I think we were at 6.93 when we sat down last time, so pretty similar number to last time, up like 60 million net. No real material changes on that table as well since our last meeting. On slide 29, just a graphical representation of those numbers over time. The yellow being total uncalled, and then the darker blue there, uncalled, is a percentage of our total market value, which I think over a long term is really how you have to look at it. The absolute numbers change as the portfolio size changes. So that number was 6.52% last time. So as a percentage of our market value, the uncalled number is actually down a little bit at 6.4%. Moving on to slide 30, nothing really to hit on there. The asset allocation history is pretty static in the past. Slide 31, exit investments. We have nothing new to report on that front. And then finally on slide 32, we can take a look at the top 20 managers. The first 2 obviously being our internal piece there. Pretty static there. I think we were 54.8% last time. Obviously, with those 2 markets struggling, that number is slightly lower as a percentage. And as a whole, I think I looked through and all the names and everything on this chart are exactly the same as they were when we sat down for our last meeting. No real material changes there either.
Are you anticipating, increasing the allocation of this class or where it is or?
Of which particular one? So this just, the first 2 were just the publics, and then the other are basically our managers on the external side.
I was looking at slide 32.
So again, 1 and 2 were internal.
Right.
So we're at 54.4% there. And then everything else are part of our externals on that. Any changes really, the internal fixed income changes have really been changes within that piece that we just talked about there. And internal equities, that number really only probably changes if market value changes or if we're doing some kind of material reallocation.
So another question would be, of the $7 billion, are you starting to get any indication that they're looking to use some of that money? Are there starting to be some opportunities out there within the fund managers?
On the uncalled side?
Yeah.
If you want, you're a private folks want to comment on that?
So the answer is yes. For the few in private equity
Just
that we have.
identify yourself so they can get it for the record.
So, some
Craig Demko.
recent.
Just identify yourself.
Oh, I'm sorry. I'm Craig Demko, Director of Private Equity. We've had a couple of new commitments made over the last, call it 18 months or so. Landmark, which you hear all the time, as well as BC Capital, HG Capital. Those managers have been able to find opportunities, but they've definitely slowed their pace. They've been very selective. In particular, one of them took a 9-month hiatus for the most part, and pulled back to really understand what was going on in the markets. And then in the last 3 months, I'd say they probably made three investments. So the opportunity is starting to show itself at more attractive valuations. The market's already set private to a degree.
Troy March with real estate. And
Can I stop for just a second? Craig mentioned Landmark because we've had guests here in the past, maybe some here today, to talk about Landmark. Every Landmark investment we make is not in residential housing. I mean, it's a whole gamut of things in Landmark. So I just want to say, when you say Landmark, it's not specific to our guests that have been here in the past, maybe here today and will be here in the future. It's a whole myriad of things inside of Landmark, right?
Correct. Yes.
I mean, that's actually a very small percentage of Landmark, so sorry.
so across real estate, back to slide 28, we've got about $2.2 billion of uncalled capital in total. To the extent that that capital is going to be called, it's probably going to be more limited to the more recent commitments that we've made over the last 18 months, where we've given new managers new dry powder to invest in. And yeah, we would expect 90% of those new commitments to be called. But out of that total $2.2 billion, well over half of that will probably never be called simply because our managers, they keep on average 8-9% in reserve. If we make a $100 million commitment, the way we model it out is they only ever really call 92% of it on average. That 8 million is their kind of rainy day in case things blow up and they need to rescue an asset or whatever. So the vast majority of what we have there, maybe not the vast majority because we've made some commitments in the last year, but probably at least 60% of that 2.2 never expect to be called. But we have made commitments this past year, and we do expect that to be called, 90% of it at least.
Right. Ronald Funderburg, do you have a question before I start? Okay. Ronald Funderburg, Director of Opportunistic Fixed Income, and I'll get a chance to talk to you about another strategy we manage, inflation-sensitive portfolios. I'll save opportunities for that later. But as it relates to opportunistic fixed income, this past year, our managers have seen incredible amounts of opportunities to deploy capital into private credit at yields to maturity north of 9% yield to maturity. And if you get some level of yield to call, you may end up getting a double-digit type of opportunity set. And also even in high yield and floating rate instruments, our managers are seeing opportunities that are abundant in this current environment. We've been working with the treasurer to capitalize on that this past quarter, or past 6 months actually. Some of our managers had uncalled capital for some of the vehicles that we manage with them, and they manage on our behalf. We work with those managers to really get that capital called. So even if you don't necessarily see new commitments, there has been incremental capital deployed into our space over the past 6 months. And then on a go-forward basis, we continue to work with the treasurer, Jeff, Chris as well, on how do we capitalize on the current opportunity set. Spreads have come in materially, but we also, along with our managers, feel that we'll get multiple bites at the apple of increased spread opportunities as the market comes to grips with there will be higher rates, and higher rates will be here for a lot longer. And as the Fed potentially navigates a soft landing or a hard landing, I don't know where it'll end up, but we feel that there will be more bites at the apple to come.
Yeah, I'm just trying to get a sense of what the institutional investors are feeling right now. Are they still as nervous as the retail investor, or are they starting to see opportunities? So thank you for that.
opportunities. This year is going to be for real estate, it's going to be a year of opportunity. Cash is king, and if you've got dry powder later this year, I think there's going to be opportunities to take advantage of other people's pain.
Yes.
About 2 to 3 years ago, there was a kind of a push to create a fund with, that would be allocated from the secondary market. And you guys were going to hold out a bit of cash, waiting for secondary market opportunities. Has that materialized? Is that happening?
So,
That involves 2 or 3 of them. So go
yeah.
ahead. We'll let
It's
Craig and
Craig
then
Nepo again.
Craig, Ron, and then Troy, if he wants to add to that question.
So we have a very large relationship again. It's with Landmark. They are our secondary manager.
Right, okay.
And they have been deploying capital. I would expect a lot of our peers I know are are over allocated toward the private markets to a degree.
Right.
They, in some instances, are selling their interest on the secondary
sector.
Not only are they pulling back, not deploying as much capital, they also may need to sell.
Right.
The secondary market has gotten so big that it is a very efficient tool for people to manage their portfolios. Now, unfortunately for them, when they're needing to sell, it's a buyer's market at this point in time. So the discounts, depends on the strategies, depends on the GP and everything. It's more attractive. So they're taking advantage of that on our behalf.
We're accommodators.
Opportunities.
Somebody wants to sell something at less than what it's worth, we accommodate them.
Not the market.
When they want to buy something for more than it's worth, we try to accommodate them too. Ron?
Nothing else to add.
Great, got it. Troy?
No.
Thank you, guys.
Thank you, Mr. Russell. Any other questions?
Thank you very much.
Thank you.
All right. Next.
Good morning. Morning. As Jeff mentioned, really big to get on the meeting agenda this particular time. Been before you before when energy markets were down or oil was down at 20 bucks in 2014, 2016. And it was a little more painful trying to talk to you all about the performance of the inflation portfolio. But today we have a pretty good story that's not just for a 1 year period, but also a multi-year period that really underpins that the strategy and all the collective efforts of everybody over the years seems to be positively working in the right direction. A lot of the investment committee conversations over the years that Jeff has spearheaded, Kevin spearheaded, everybody else, even Patricia Garrett, et cetera, seems to be working out overall.
Introduce your guest there.
And today I have John Krudewig, one of the analysts on the team. He's going to talk to you a little bit about the macro environment for inflation sensitive portfolios. And I'll talk to you a little bit about the performance and the history of the portfolio. And then talk to you a little bit about what this means for the future.
This is the $5 billion sleeve.
Yes, sir. Again, as mentioned, the inflation sensitive portfolio is performing as originally designed. Diversification has proven to be value added. Some of the slides in the back speak to that, especially slide number 26, that really highlights the diversification by vintage and by strategy over a period of time. And you can see in that particular slide that various strategies that we added over time have been accretive to the portfolio. Number three, the macro environment for inflation is uncertain at best in the environment. Next slide. Here we have 5 elements that set the foundation for the role of the inflation portfolio. We want to provide inflation protection, absolute returns that are attractive, competitive returns relative to our benchmarks, diversification, and also provide liquidity when other portfolios may be experiencing lower liquidity due to unanticipated inflation. Next slide. The next 3 slides will talk about the portfolio history. This particular slide is a 10-year look back at the portfolio. On the left-hand side, 10 years ago, you see the orange and gray bars. The orange bar is mostly publicly traded natural resource futures, and the gray bar is privately held natural resources. Those 2 particular portfolios house most of the volatility of the strategy. And as you see over time, we've diversified into green bars and gray bars, green bars into the blue bars. The blue bars are inflation-linked bonds or replicas, things that are meant to approximate the performance of TIPS. And then the green bar is a diversified holding of infrastructure assets, other lending assets that are meant to provide diversification over time. And over time, you see that we have a pretty diversified portfolio across green, gray, and blue. Next slide.
That's a quick question.
Yes, sir.
So you mentioned a product that simulates tips.
Yes.
What would be the spread between real tips and the simulated tips?
So over time, that's a good question. Over time, I don't know the spread difference off the top of my head, but we can talk about the performance of said.
But there's a reason you're buying those assets as opposed to.
Correct. At the inception of that strategy portfolio, at the inception of what we call a staging portfolio, we wanted to have an allocation to TIPS so that we could use TIPS as a source of funds as we funded other investments. One of the issues with TIPS was the duration component, or what would happen in the event that there was inflation and rates were to increase dramatically. We thought that
Like happened.
like what happened. Yes, sir. So what we wanted to do is create what we call an inflation-linked bond portfolio that generated income or had floating rate instruments in them. So we have a significant amount of one particular portfolio. Half of that portfolio is floating rate securities, and floating rate securities performed better in last year's environment as SOFR increased to more than 4%. So just last year, we clipped 4% just from SOFR with our floating rate portfolio.
Sorry, it will turn out to be a short question, turn out to be a long answer.
No worries. No worries. And then we do have TIPS in that portfolio as well, but the performance of TIPS, 1 to 3 year TIPS last year was down approximately 2%. But if you held 5 to 10 year TIPS, you'd be down closer to 12%. And then our TIPS, our inflation-linked bond portfolio that kind of was meant to approximate the performance of TIPS, but maybe with enhanced yield or enhanced protection. That particular portfolio was only down about 2% as well last year. So we did really well.
I think Ron's point is I hate to say TIPS were exposed last year, but the perception always is, oh, well, I'm buying this TIPS because it gives me protection against the inflation. Inflation is at 9%. You heard her talk about the numbers there because you're still exposed to real rates.
Yeah, you are.
So I think people had, that in their portfolio thinking that was what it was going to do at the end of the day on it. It was a rude awakening.
And it creates little slivers of opportunities that you have to be ready to jump in now.
Exactly, yeah.
Yeah, it was a thoughtful decision by the investment committee for us to put together what we called a staging portfolio that completely was meant to replicate the performance of TIPS, but do a little bit better, enhance yield and go through various scenarios in which maybe rates were rising, this portfolio would perform better, or if rates went down, we might actually be exposed to some of the duration in our benchmark
market tips in previous years. We've talked about that when
Good example, I think the iShares from a break, iShares on ETF was down 12%. Their tips, iShares. Right.
12%. Well, like equities.
again, this particular slide just shows that over time since 2006, how the portfolio has been allocated by commitments to various strategies. Again, the left-hand side has been mostly private natural resources and commodity futures. And then over the second half of the life of the portfolio has been more diversifiers and inflation-linked bonds. Next slide. Again, this slide really summarizes where we are today. The left hand, we're pretty much a third other real assets and diversifiers. We're about a third private natural resources, and then we're about 1/4 inflation-linked bonds, with the balance into publicly natural resources in the orange. Where remember the publicly natural resource orange piece used to be the majority of the portfolio, and moving forward, that particular slice may be less and less going forward.
I don't think we've seen this chart before.
It's been in everyone, at least for the past 5 years.
It's only see it once a year.
Maybe so. But am I looking at this correctly? The 37% gray in the pie chart is it timber? Is all of that timber?
Sir, not all, no, sir. Not approximately $900 million is timber.
Okay.
And then we have,
So it's 37%, 900 million of that is timber.
yes, sir.
It should be red, not gray.
I was going to make some comment, but I'll let your comment stand.
Red was a power color this weekend.
And so that's the gray is where timber would be housed. So $900 million is in that particular portfolio, but that portfolio is still diversified across mining, metals, upstream oriented strategies, even debt strategies that have a nexus to lending to natural resources would be housed in that gray sphere, portion of the sphere. And again, the gray and the orange is something that we fought over the last 7 years to reduce the exposure due to the volatility that those two portfolios provide. So the amount of volatility and downside risk that those two subcomponents provide in a deflationary environment could be really high.
But it has been a good year to be overweighted on natural resources.
Yes, sir. At the beginning of the
Really
year.
good year.
Yes, sir.
Oh, no, it's Ron's trying to have a really good conversation. You keep bringing up timber.
Didn't realize I brought up timber.
Timber even had a good year last year. Timber even had a pretty good year
If you
last year.
sold it.
Operating timber was very strong last year.
They paid the property tax.
You don't pay property tax.
Sure. So evaluations aren't in just, all of them aren't in just yet, but the few valuations that we received for the Timberland portfolio, last year's appreciation was closer to 8, maybe on the baseline for several of the properties that we've seen. We're going to continue to get additional quarterly valuations in for last year, but even timber had a pretty attractive year on a paper gain as it relates to paper, but also operations where you're generating income. Timber had a pretty strong year.
Reverend Jason, if you get bored, maybe you can get our property tax exemption for our timber portfolio, which is owned by a nonprofit pension plan, maybe even retroactively. That'd be a slow project you might want to work on.
Noted.
Next slide.
Like 100 basis points a year in property tax.
Wow. Okay. This particular slide highlights the historical performance for the Timberland portfolio,
Sorry. Inflation sensitive portfolio. I wish it was a portfolio. Since inception, the portfolio has generated a 1.7% return, and that 1.7, that pretty much tracks the long-term expectation views for inflation. It's what the Fed has been tracking towards over the long term. They want to have inflation somewhere between 1% and 3%. But if you look at inside of the last 7 years, our portfolio has generated north of the 6% annualized rate of return pretty steadily across multiple years, and it's especially on an annualized basis. Last year, we're close to a 10% rate of return, and 2021, we had a 12% rate of return. Pretty strong years relative to our benchmarks. And over the last 5 years, the portfolio seems to be generating and performing as expected. Next slide, we'll get a chance to talk to you about some of the drivers and what areas of outperformance. The green circles represent our portfolio's performance as it relates to other real assets and diversifiers.
Ron, let me interrupt.
Yes, sir.
10% is an actual performance where equity markets were down 20% in the last 1 year.
Yes, sir.
It's not a relative performance, it's actual.
It's actual. So that underscores the importance of diversification. The green circles represent the performance of our other real assets and diversifiers over the past 10 years. That particular sub strategy, we've generated north of a 10% on a 10-year basis, 7-year basis, 5 and 3 and 1 year basis. That particular portfolio has been very accretive to the plan. And contrast to that, one particular portion of the portfolio that hasn't been as accretive is the blue bars and the blue circles. That's the portfolio that houses our inflation-linked bonds. I'm not super excited about that, but as Jeff mentioned, still performed better than just the tips only, or if you had long duration tips, that particular portion of the portfolio would have been down materially more than what we showcase here. So we see on the both sides where one side of our portfolio has done really, really well, one strategy has done really, really well, barbell by the inflation-linked bonds portfolio that has really weighed down the long-term performance of our portfolio. But both strategies seem to be necessary and an important driver of diversification for the long-term performance of our portfolio. And everything else has been a mixed bag, especially as it relates to publicly traded natural resources. Over the life of that particular portfolio, that has generated closer to zero. And if you adjust for inflation, it's definitely been negative for publicly traded natural resources. And then over the last 3 to 5 years, publicly traded natural resources have been a positive for the portfolio. And then last year, we decided to monetize a portion of our publicly traded natural resources after we saw and experienced a major pop in that particular asset class. And as the Fed continues to fight inflation on our behalf, we may consider reducing our exposure to the publicly traded natural resources. I'm gonna, next slide. This slide underscores what the treasurer just mentioned. This slide contains the metrics for diversification, showing how this particular portfolio has provided diversification relative to the total plan. Anything close to zero indicates that diversification has been positive, that it's truly uncorrelated. Anything closer to 0.5 or higher means that the asset classes are more correlated. I'm gonna draw your attention to the red, the core real estate portfolio over the last 3 and 5 year periods. Our portfolio is highly correlated to that, which is what we're hoping to achieve as people perceive real estate to be one of the better hedges against inflation. And so basically, this particular slide underscores that the inflation-sensitive portfolio is performing according to strategy, providing diversification, providing inflation diversification, and then less correlated to other sub-strategies that are housed within the fund. And then at the bottom slide, that shows our net portfolio distributions. Over the last 2 years, this portfolio has generated net cash flow of about $1.5 billion, with $800 million coming last in the environments that we're in. So it's not just paper gains that we're experiencing. These are actual realized gains where our managers are genuinely selling in this environment, and we're monetizing several of the gains that you see on paper. They're actually converting to cash over the last 2 years. Next slide. This slide showcases our current benchmark on a dollar weighted basis on the right-hand side. And then the left-hand side really shows how the team thinks about what our long-term benchmark should be. Should be half dynamically weighted based on other real assets and diversifiers, third long-term tips, and then balanced out by Bloomberg Commodity Index. That's what we think about over a long period of time, but the right-hand side shows our benchmark as it currently stands today based on the investments that we have in the portfolio. Next slide. I'm going to hand it over to John to talk to you a little bit about the inflation-sensitive environment.
Yeah, thank you, Ron. So over the past year, inflation's been incredibly rampant. June of 2022, we actually had year-over-year inflation growth of 9.1%. That's the highest inflation growth we've had since 1980. Luckily, since then, it's moderated down to right around 6.5. And then the most recent print that we had for January had inflation year-over-year growth at 6.4%, which is actually higher than the expected 6.1%. So it still remains uncertain. Slide, please. This isn't just a US phenomenon. We see this in most developed global nations. So Canada, Australia, France, Germany, United Kingdom, they all have it in some form or fashion. Earlier in 2022, right around March, once we saw really high inflation, the Fed started to respond by raising federal interest rates. This got to a point where they were raising rates very quickly, the fastest and some of the largest Fed interest rates that we saw in the history of capital markets. And this has led to a dramatic slowdown in IPOs, almost non-existent, and debt is substantially more expensive, all leading to an overall slower financial market. Go to the next slide. We'll see that there are some subsectors that remain relatively sticky, though. So specifically labor, we can see that the gap between the unemployment rate and the job openings is even bigger now than it was before the pandemic. Couple that with the year-over-year change in hourly earnings on the bottom left-hand side, we see that we're still materially higher, and we're looking at the average weekly hours on the bottom right-hand side. We see that over the past year, that's still declining. All of this points to an incredibly resilient, incredibly strong labor market. It's still pretty heated up. Let's go on to the next one. We have another sticky sector. It's going to be housing. This one has a more direct tie with federal interest rates. We see the pretty sharp decline in home price appreciation due to that increase in borrowing costs. And then what I think is the most important one here is the housing affordability index. We can see that it's the lowest that it's been since the great financial crisis, a crisis that had its foundation in unaffordability of housing as it was. When we also couple that with high household owners' equity and supply that is still kind of lagging where we would like to see it, overall, we still see this as a fairly sticky market. And then if we go to the next slide, we'll see a sector that has seen improvement, though. So at the beginning of COVID, we saw a mass printing of money. This degraded the dollar value abroad. Then once we stopped printing, we saw kind of moderation. And then once we saw rate hikes in early 2022, we saw the value come back into this past quarter where we saw it degrade again, mostly due to an imbalance of rate hikes from other developed central banks across the globe. But we do expect that to get back to a strong point and see the dollar value continue to be fairly strong. On the next slide. And then where does this take inflation? That is the million or billion dollar question. The expectation for inflation at the end of next year is going to be 4.99%. And with that, the the market's assuming that we will then also have rate cuts towards the end of this next year. I will say all of those conversations around rate cuts at the end of this year and what inflation will be at the end of the year is very fluid. I mean, from the time that we made this slide to today, these expectations have changed. And it's all relatively uncertain. There's constant debate for a hard landing, a soft landing, even conversations of a no landing scenario. So overall, everything is relatively uncertain. So with that, we'll pass it back to Ron to go forward outlook for the portfolio.
Ron, before you move, what was that comment you just made about no
No landing.
landing?
Right. So we
What is
kind of
that?
sit in this sticky, stagnant area of somewhat
Stagflation?
moderate inflation, and it would cause rates to have to remain a lot higher for longer, and we don't get anything that's too meaningful for the Fed to actually cut rates.
Thank you.
Excellent.
This brings us back to the factors that could impact inflation to the upside, and that is the reopening of China, continued low employment levels and shortages in employment in various sectors, continued supply chain disruptions. You could see inflation retrace back up or stay higher longer. And then on the downward side, if we experience a recession or we see lower wage growth, maybe those particular factors could be downward on inflation moving forward. And then geopolitical things as it relates to U.S.-China trade war and other things that are happening on a geopolitical basis, completely uncertain as to the drivers of the board views on inflation. Next slide. What this brings us to is what's important for us on a go-forward basis. We saw the importance of diversification and how that's been to the performance of the strategy. These are the strategies that continue to be important to us. Energy, technology, infrastructure like cell towers, data centers, logistics, transportation, secondaries. Healthcare is something that we don't really have a lot of exposure in right now, but we continue to do a lot of research in healthcare to understand how inflation impacts that particular area. And then real estate. These are the areas that we want to continue investing in on a long-term basis. We're going to be mindful of the valuations in each of the strategies and navigate those markets accordingly. And for 2023, the number one thing we want to do is focus on our high conviction managers and high conviction opportunities. Again, we want to try to maintain vintage and strategy diversification. And then new for this year, we're really going to sit down and continue to monetize strategies that may be more susceptible to a recession or deflationary pressures that could come our way, i.e. commodity futures, i.e. timber when it makes sense, i.e. any other strategy that we feel that if we hit a recession or the downside risk of owning that asset or security any longer doesn't benefit the plan. That brings us to the conclusion. Any additional questions?
Well, your efforts were justified.
Thank other people. I'm just one person in the wheel, but as it relates to the IAC over a period of time to work with the plan to create the inflation sensitive portfolio, to the treasurer, to everybody who's been part of it. I'm just one part. John's just one part, but I think everybody.
John, do you remember inflation being so high in 1980?
I didn't remember anything back in the
I think
That's Kim when he remembers in the 70s.
The interesting thing.
We'll go to you next, sir.
No, but I think the interesting thing is the unemployment rate, and I don't know if the data really reflects where we are with the economy. Just in going around our neighborhood and driving around, we don't see the help wanted signs as much, which in Huntersville is a pretty.
We do here.
Do you?
Oh, yes.
We don't see it, and a lot of public companies have big layoffs in terms of technology, but a lot of the other ones are talking about, the fact that they're at a pretty good place for their employment. So just going to, there's that gap between what we need and who we are and how many people we have to work. And it's a skills gap. We've aged. A lot of us decide not to work anymore at 55 and older. I just don't know how much rates is going to affect some of those things.
Yeah. I think they're definitely disjointed. They're definitely independent things. And I also believe that our policy on immigration could impact labor wages and things of that nature. You can also see on slide 13 of our deck, the average weekly hours come down from 35 to 34, back to normal over the past several years. So, just looking at that, maybe there's less overtime. Maybe some factories aren't running 3 shifts anymore to catch up. Almost to your point, as it relates to less help wanted signs. So we'll see what happens on a go-forward basis. We're monitoring the layoffs, especially in the tech space. We're seeing a lot of things as it relates to rich session, and don't necessarily know what does that mean, a rich session. That is, maybe the millennials that are working at all these tech companies, they were buying all these homes, pushing home values up. Maybe they're less so in the marketplace moving forward. We also really believe that housing is going to be a big factor into the Fed's go forward rate policy. Because housing represented approximately 33% of CPI this past year. So whatever happens to housing will probably impact the Fed's forward-looking actions, in my opinion.
And then on the topic of unemployment, I feel as if part of it is also kind of like sector specific. So, and then in the tech sector, it's hard to get a job right now. There's, 400 people applying to development jobs because of all the layoffs. But, I have friends back in Arizona that run pipeline businesses that can't find people to actually show up to work that can actually weld, right? It really seems to be region specific, sector specific. So it's a fairly complicated topic.
And we are in a post-Phillips curve era also, which we don't know what's going to happen. Yes, we're operating for 50 years based on the Phillips curve. It's gone. I don't know what's going to happen.
Yeah. So there's a small thing coming through several legislatures across this country, and possibly even Congress, about not taxing overtime pay. And I can't forecast what that would do to the employment crisis, but I think it would change it in some way, where if people work overtime, don't get taxed on that. I think that would, if that happens, I think that would change some things. And the unemployment rate as well as CPI are two of the most misnamed things in our society. As a person who ran that agency for 3 years, the unemployment rate only includes those that are able, available, and seeking employment. So is that really an unemployment rate? And we know all the warts that are on CPI, often stated without food and energy. So I wish they would get real about what these terms mean, because average people rely on these terms as being the gospel when they really do, in many instances, mischaracterize what it is they're trying to describe.
Chairman Powell just came out with a new one, right? Super core inflation.
Super what?
Super core. In one of his most recent.
How's he want to say stack? Had to find another word with an S in it. Because he doesn't want to say stagflation. So, Lars, you want to talk about the 60s and 70s?
Well, I certainly could.
Okay, I'm sorry.
But times have sort of shifted back to the late 70s. The only thing we don't have now is gas shortages, fuel shortages. That must be the electric cars doing that.
I think Lawrence will back me up on this as well as some others, but if you'd have bought $1,000 worth of stocks on average in some of these companies, TAM Brands, AT&T, Coca-Cola, American Express, IBM, on average, if you'd have put $1,000 investment in those companies in 1973, it took you to 1985 for your 1,000 to be worth 1,000 again. Not to double, just to be worth what it was worth when you bought it, right? On average.
However, in the late 70s, for $80,000, you could buy a deep discount, non-interest bearing bond, $1 million for 80,000.
Right.
That's a 20-year bond. You get a 16% CD. Good.
I don't want that.
Huh?
I don't want that.
If that happened, I'd be in the bond market buying back our debt. So I just wanted to let everybody know that. So.
So I missed the last meeting, but I certainly am glad to hear this reports today were much better than what I missed last meeting. Thank you very much.
Thank you. So if you're going to miss one, last one was a good one to miss. This one was a good one.
Well, that's true, but I was at Disney World.
Well deserved, I'm sure.
You need a loan now? No, that's one money at Disney World. No.
There are no senior citizen discounts at Disney World, are there?
What's that?
There are no senior citizen discounts at Disney World.
No.
Which I'm entitled to, by the way. So, all right. Any other questions for Ron and John?
Great work, guys.
You're well done to the team.
Thank you. We're now to our part of our meeting for meeting open to the public. We have a couple of guests, Justin and Madeline. If you'd like to come forward. Somebody will scoot a chair up there, don't mind, or wherever you like to sit.
You tell me, it's your house. I sit right here.
I'll let you go first and then come up in a bit. 'Cause I gotta-
We got a place, Madeline.
Oh,
Are you on the same subject? Are y'all talking about the same subject?
Generally, yes.
Right. Welcome.
Thank you. Good morning.
And have you been here before?
Not in person.
Not in
It's
person.
much better than via video. You might have heard my voice, but
Being general counsel is going to give us the rules about public.
It's just generally 3 minutes and I'll time you and then I'll give you probably a 30-second warning. So go ahead.
fair enough. Good morning, everybody. Treasury Committee. My name is Justin Flores at the Private Equity Stakeholder Project. And my colleague, so you've spoken at the last couple of meetings as Treasurer referenced about the landmark issue. And sent a couple of messages to staff to try to set up a meeting to discuss these things. And I just want to reiterate that offer and that opportunity. It's totally possible that we meet and we agree to disagree, and it's totally possible that we can find some common ground and somewhere to move on this issue of the housing crisis and the way that the investments have affected that. So just want to start by appreciative of having the opportunity to talk and kind of reiterate that opportunity to meet. The last fall, we put out a report about the NCRS investments in Landmark, $2.6 billion since 2017. And no other pension fund has invested more than $500 million, as you mentioned, that not all of that money is going into single family rentals or housing. While we didn't receive a response to those requests for a meeting, we do want to continue to meet. We did receive a report from representatives that I believe came out of the Treasurer's office, kind of trying to clarify some of those investments and where they are and where they're not. We did look at those and still think it's worthwhile to talk about the investment's effect on the housing issue. 200 million in Landmark is in Real Estate Partners 8, which is the fund that invested in 20,000 homes owned by Pretium. And so this is still part of a company that has owned 14,500 single-family rental homes, meaning that the NCRS is invested in about 35,000 homes owned by Progress Residential in the state. So Progress Residential being the now largest single-family rental company in the country, is being sued by the Minnesota Attorney General. It's been singled out by congressional reports for filing evictions during the federal eviction moratorium. Has been the subject of numerous media stories about treatments of tenants, including in North Carolina. And just last month, the city of Minneapolis imposed some specific conditions on Progress that it has to meet in order to operate there. An Atlanta TV story ran about how some Progress tenants had their water shut off unfairly. And Progress continues to grow at a rapid pace, adding 2,000 new homes a month. So at this rate, Progress will own over 100,000 single-family rental homes by the end of the year. And we believe that the NCRS has played a big role in that growth. And so the opportunity to see some of those materials that were sent was helpful. We do think that it still is playing a big role in the housing market here in the state. And so being one of Landmark's top investors, we believe that the NCRS is in a unique position on behalf of North Carolina tenants to play a role in resolving these issues. So with that, I'll end my comments and once again, reiterate, I have cards. I'd be happy to speak with staff or anybody after the meeting. Thank you.
Amen.
And I'd like to read a comment on behalf of a retiree who was going to come but couldn't make it today. Is that all right? All right, here's your comment. By the way, my name is Madeline Banks and I'm also with Private Equity Stakeholder Project. As follows. My name is Susie Winters and I'm a retiree from Central Piedmont Community College in Charlotte. I'm a member of the Mission Board of St. Martin's Episcopal Church. One of our core objectives, is to promote housing justice in our community. We ask what can be done to help our neighbors before they experience homelessness or housing insecurity. To that end, we've developed a relationship with Action North Carolina and its local tenant organizing resource center. Through this relationship, we've become aware of the corporate housing ownership crisis that exists in the state, specifically in Charlotte. We are in touch with many tenants who are renting from corporate landlords and face extraordinary challenges. They're experiencing year-over-year rent increases of 10 to 30%, as well as upkeep and repairs that go undone. Many of these tenants attempted to purchase homes in middle-class neighborhoods, but were unable to, as large corporate owners purchased the homes with full cash offers, usually over asking price, which pushed out these potential first-time owners. These corporate landlords, including Landmark Progress's aggressive acquisition practices, have artificially inflated housing costs to the point where the government employees for whom the pension fund exists can no longer afford housing. The living wage in Mecklenburg County in 2022 was $36,504. The median government employee wages in North Carolina are $73,504. In April of 2022, the annual income required to purchase a median home price in Mecklenburg County was $105,000. As a recipient of a pension from the state of North Carolina, I'm pleased that the health of the fund is strong. Sorry, I lost my place. If the goal of the fund is to invest in funds that maximize for the benefit of state employees, I believe that benefit includes looking at the costs associated with those investments. I humbly ask that the power and strength that you exhibited to build a healthy retirement fund, you use this strength to pressure corporate funds managers to require these landlords to cap future increases at no more than 3% and to maintain local resources in each community for property management that is responsive to their tenants. Respectfully, Susie Winters.
Like to add anything to what she said?
Sorry.
Would you like to add anything to what she said?
I think between Justin and her very incredible words, I think it speaks for itself.
You did a good job in her absence. So.
Thank you.
Okay. Thank you. Hang around a few minutes if you can. We'll now deem the public comment section closed. And with that, we'll go around the horn. So we've got some changes in our board, but in some respects, I've asked Greg to stay on as a member of the IEC for his expertise and professionalism and the continuity of what he has brought to this board over the years. As a member of the IEC, he was a member of the Teasers and Elders, which got him a slot here. And so, Greg, thank you for.
Glad to be. I was sharing. I unceremoniously received my name plaque in the mail. So that's when I realized it's over on the other board. But I'm delighted to be
I signed
here.
the back of it.
Oh, you did?
You didn't notice?
I got it on eBay right now.
All it doesn't end up back in the Chiefs division. Anyway, go ahead.
I'm honored to continue to serve and just continue to be amazed at the wonderful things that staff does, that they truly have the fiduciary interest of the state employees.
I think I've occupied the time. Oh, Lord, thank you. But again, to the staff and you guys too, thanks for being here. Thanks for sharing your thoughts. You know, it's always good to hear people who are convicted in what they're working on. So great job. And thank you, staff too. Great. I always learn something when I come here. So thank you.
And Mike's joining us today, and he and Dr. Peter Roby sitting in the front row. Dr. Roby's on the State Health Plan Board. We've got a meeting starting at 1 o'clock for 3 or 4 hours. So Mike's going to have an opportunity to see how the State Health Plan Board functions. And Dr. Roby's had an opportunity to see how the one of the largest pools of public money's Investment Advisory Committee functions. So, Dr. Roby, thank you. Lars.
Glad to have a good report today. Thank the staff. That was great. I've been wondering if you were enjoying poking bears.
Talking to him?
No, I'm not. You need to slow down on that.
On poking bears?
Poking bears.
It's when you're 65 years old, you realize that most of the blood that's pumping through you every day is not yours. You know, it's based on your nature and your nurture. And as I've studied more into my Quaker heritage, I'm a member of Springfield Friends. I've realized that spice, to be fair and just, is one of the strongest spices there is. And it doesn't really allow you to look the other way when you see things that aren't fair and aren't just.
And that's really good.
So you blame it on the Quakers. I will say, as any of you who are interested in that, in Friends, we're celebrating our 250th anniversary this year of our church. So we were there before our country was there, near the southern part of High Point, and on May 7th, and it's going to be a great Quaker celebration. And you may not be a Quaker now, but there are a lot of people in this room who were, whose ancestors were Quakers. So you're all welcome. May 6th and May 7th. There's one of our members of our church who's on a gas station around the corner, and I think his son is one of the leading symphony leaders in the world, and he's coming in to do a concert the night before. And then another member of our church is one of the singers in a company called MIPSA. I don't think they were Grammy-nominated. I don't think they were nominated for a Grammy, but they're very, very popular folk group. You may have heard of them. And so anyway, that's my response to your good deep poking bears.
Okay.
If you'd have poked a few more bears 35 years ago, Salem,
right,
I wouldn't have to poke as many as I do now. And the bears have gotten a lot bigger. And there's a lot more of them. So, but anyway, thank you. Welcome back. Mayor.
Well, first of all, I didn't know Quakers do celebrate, so I wish you all the best with that. No, I think what we've been through this year, and I've been in the investment business for 37 years, I think, 37 years. You are reminded during these times why diversification is key, why, just following the latest craze is not the best thing to do. And when you're investing for other people's money, I think you all have a good understanding of what you're doing here, that sometimes we do take the hits when we're underperforming relative to a particular benchmark, but clearly when that benchmark's down 20%, you're only down 10. And this was probably one of the most extraordinary years because of fixed income doing so poorly when equities were doing poorly. Did a pretty good job. So
Just to add on to John's comment, it's nice that nowhere in any material is the word crypto mentioned.
Or Bitcoin.
Yep.
Yes. So, thank you, Mayor. I want to thank everybody for attending today, and
Lance is also, Mr. Brewer is also on.
oh, hey, Lance, how are you?
Hey, Treasurer. Good morning still. Appreciate
Yes.
everybody's efforts. The staff did a great job and enjoyed the presentations. And again, glad to have Greg stay on. Echo your sentiments and glad to have him on the team.
All right. Thank you all very much. I'd like to adjourn our meeting today in honor of Senator Jim Broyhill, who passed away last Saturday. A congressman from mainly the Lenore area of North Carolina, who ultimately was a U.S. Senator. Many people know the Broyhill name. And I can say as a public servant, there are many like me who either are or should stand on his shoulders in his absence. So we'll keep Senator Broyhill and his family in our thoughts and prayers. So with that, I'll entertain a motion to adjourn.
make a motion to adjourn. John Anarella.
Second.
Motion second. Any further discussion? If not, the clerk will call the roll.
Mr. Brewer?
Aye.
Mr. Mevin?
Here.
Mr. Patterson?
Aye.
And Treasurer Fall.
And before I gavel out, let me just mention, because we do get a lot of inquiries around BlackRock. As you can see on our list, they're the largest outside investment we have. To kind of clarify what we've done there is that unlike what some other states have done, we negotiate our fees with BlackRock to the lowest possible rates, thanks to the people in this room and various divisions who, in a way that gives those that we have the responsibility for the highest value at the lowest cost with the highest margin of safety. And we were successful in doing that. Secondly, we removed our proxies from BlackRock. We now have those here at 3200 Atlantic Avenue. We availed ourselves of one of their choice program so that they can no longer politicize our pension assets. However you feel about that topic, one way or the other. And so I think what we did on this particular topic is we governed and we led, and we did it with common sense, making sure that we maintain our loyalty to those that teach, protect, and serve. So just want to remind all the IAC members of exactly what happened there. So, okay. Adjourned. Thank you.
Thank you, Treasurer.